If it feels like everything is getting more expensive, you're not imagining it. Between 2008 and 2022, the Federal Reserve created $9 trillion out of thin air. But here's the part almost nobody tells you. That money didn't go to you. And once you see where it actually went, you'll understand why your groceries, your rent, and everyday life keep getting more expensive. In this video, you'll see exactly how this happened and what it could mean for the prices you'll be paying in the coming years. Let me start with a quick reality check. Most people think the Federal Reserve is a government agency. It's not. The Fed is a private institution, technically a hybrid, created by Congress in 1913, but not owned by taxpayers. It's owned by member banks. And here's the twist. The Fed doesn't need to ask Congress for money to spend. It creates money as part of its normal operations. Think about that for a second. There's an organization that can create money, and it's not exactly the government, and it's not exactly a private corporation. It's something in between. Accountable to almost no one in real time, making decisions that affect every single person who earns a paycheck, pays rent, or buys groceries. Sounds like the setup for a conspiracy theory, right? Except this is not a conspiracy theory. This is how the American financial system has worked for over 100 years. This is publicly documented. The numbers are on the Fed's own website, so let's walk through what actually happened. The first wave came after the 2008 financial crisis. You remember the collapse, Lehman Brothers going bankrupt, the housing market imploding, banks freezing up. The Fed panicked. They launched what they called quantitative easing, or QE. Great name, right? Sounds like medicine. Sounds scientific. Sounds like something that helps you. Between 2008 and 2015, the Fed created roughly $3.5 trillion. They used it to buy government bonds and mortgage-backed securities, essentially toxic assets that banks were drowning in. They took the bad stuff off the bank's books and replaced it with fresh, clean money. The second wave was even bigger. In March 2020, when COVID-19 shut down the global economy, the Fed went into overdrive. In just 2 months, March and April of 2020, they created more than $3 trillion. For context, that's more money than they printed in the entire 7 years after 2008. By the time it was all over, the Fed's balance sheet had grown from around $900 billion in 2008 to nearly $9 trillion by 2022. That's a tenfold increase in the amount of money pumped into the system. $9 trillion. Created from nothing in just over a decade, but created and then sent where exactly? Okay, so here's where it gets fascinating and a little infuriating depending on your situation. When the Fed creates money through quantitative easing, it doesn't send checks to ordinary people. It doesn't deposit anything in your account. The process works like this. Step 1, the Fed decides to buy assets, usually U.S. Treasury bonds or mortgage-backed securities. Step 2, it contacts what are called primary dealers, a small group of roughly 20 large financial institutions. Banks like JP Morgan Chase, Goldman Sachs, Citigroup, Bank of America. These are the only institutions allowed to trade directly with the Fed. Step 3. The Fed buys the assets from these banks. It pays them by literally like crediting their reserve accounts at the Fed with newly created digital dollars. Step 4. The banks now have enormous amounts of fresh money sitting in their reserve accounts. And this is where the story gets interesting. What did the banks do with the money? Did the banks lend this money to small businesses, to families trying to buy homes, to people starting companies that create jobs? Some of it, yes, but a massive portion of it went somewhere else entirely. Let me give you a real example. In 2010, the S&P 500, the index of America's 500 largest companies, was trading around 1,100 points. By early 2022, it had hit 4,800 points. That's a 4 times increase in just 12 years. Now, during that same period, did American workers' wages go up 4-fold? No. Did corporate earnings increase by 4 times? Not even close. What actually happened is that cheap, abundant money that the banks could borrow at near zero interest rates, flooded into financial markets. Banks, hedge funds, and investment firms took that cheap money and bought stocks. They bought real estate. They bought bonds. They bought anything that could generate a return. Because why would you let money sit doing nothing when you can borrow it for almost zero cost and invest it for a 7% or 10% return? The result was a massive decade-long bull market in almost every financial asset on the planet. Stocks went up. Home prices went up. Art went up. Crypto went up. Everything that could be bought with capital went up. Who owns these assets? And here's the core of the story. According to the Federal Reserve's own data, the Survey of Consumer Finances, the wealthiest 10% of Americans own approximately 93% of all stocks. The top 1% alone own around 54% of all stocks. So, when $9 trillion enters the financial system and inflates asset prices, the people who benefit most are the people who already own the most assets. Let me make this personal. Imagine two Americans. Call them James and Ben. James is a school teacher in Ohio. He earns $53,000 a year. He has $7,000 in a savings account earning 0.01% interest. He rents an apartment because he can't afford to buy. Ben is a hedge fund manager in Manhattan. He manages $1 billion in assets. He owns a penthouse apartment worth $17 million. He has a diversified portfolio of stocks, bonds, and real estate. The Fed creates $9 trillion and injects it into the financial system. Ben's portfolio goes up by hundreds of millions of dollars. His apartment is now worth $25 million. His assets have skyrocketed in value. Not because he did anything more productive, but because the cost of money collapsed and everyone is chasing yield. James' savings account is still earning 0.01%. His salary went up $1,200 last year, but his rent went up $4,800 because his landlord's property values tripled and he's raising rents to match. James is now poorer in real terms. He's working harder and falling further behind. The Fed just made Ben vastly richer and James measurably poorer. And no politician voted on it. No one asked James' opinion. It just happened as a mechanical consequence of monetary policy. Now let's talk about your grocery bill, because this is where it gets very concrete, very real, and very close to home. For a long time, roughly from 2008 to 2020, all that money printing didn't create visible consumer inflation, and economists at the Fed used this as evidence that their policies were safe. Look, they said, we've been doing this for years and inflation is still low. We're fine. But they were measuring the wrong thing. The official Consumer Price Index, the CPI, measures the price of consumer goods like food, gas, clothes. It doesn't fully capture the price of assets like stocks and housing. So when asset prices exploded, stocks tripling, housing doubling, art markets going wild, the CPI said, inflation? What inflation? Everything's fine. But then COVID happened, and three things collided at once. First, the Fed created $3 trillion in 60 days, the fastest money creation in history. Second, Congress sent direct stimulus checks to ordinary Americans. $1,200, $600, $1,400. For the first time, newly created money was reaching real people with real spending power. Third, global supply chains collapsed, factories shut down, shipping containers were stuck in wrong ports, semiconductor shortages rippled through entire industries. Suddenly, you had more money chasing fewer goods. That is the textbook definition of inflation. Let me give you numbers that you can verify yourself. In January 2020, before COVID, the average price of a dozen eggs in the United States was about $1.48. By January 2023, that same dozen eggs cost $4.82. That's a 225% increase in 3 years. Chicken breast, up about 40% in 2 years. Ground beef, up nearly 30%. Butter, bread, milk, orange juice, all significantly higher. The Bureau of Labor Statistics reported that overall grocery prices rose about 21% between 2020 and 2023. That might sound modest until you realize that for a family of 4 spending $1,000 per month on groceries, that's an extra $210 every single month. $2,520 per year. Gone. And where is your salary in all of this? The average American worker saw wages increase by about 15% over the same period, which means, in real terms, most American workers took a pay cut, not because they worked less, not because they became less productive, but because the purchasing power of their dollar was quietly, systematically eroded. This is what economists call the inflation tax. Nobody votes for it. Nobody announces it. It just happens. And it hits hardest the people who live on fixed incomes, who have their savings in cash, who depend on a paycheck rather than an investment portfolio. Now, here's something I want to be very clear about. When inflation hit in 2021 and 2022, the public and media narrative centered on 2 culprits. The first was supply chain disruptions, the idea that COVID broke global trade routes and that's why prices went up. The second was corporate greed, the idea that companies like Tyson Foods or Kraft Heinz were gouging consumers. Both of these things are partially true. Supply chains were genuinely disrupted, and some companies absolutely did use the cover of inflation to expand their margins. But here's what that narrative conveniently leaves out. Supply chains have been disrupted before. Droughts happen, pandemics happen, wars happen, but you don't get 8% inflation simply from supply disruptions. You also need the monetary conditions, the flood of money in the system, to turn a temporary shock into a sustained price spiral. Think of it like this. Imagine a river. The supply chain disruption is a rock that falls into the river, temporarily blocking the flow. Under normal conditions, the water backs up a little, then finds a way around the rock. But now imagine someone opened a floodgate upstream, $9 trillion worth of extra water. Now that same small rock creates a massive flood that drowns the entire valley downstream. The rock alone didn't cause the flood, the extra water did. I want to now talk about something that almost never gets discussed in mainstream media, and that's the concept of the Cantillon effect. Richard Cantillon was an 18th century Irish-French economist who made a simple but profound observation. When new money is created, it doesn't affect everyone equally. The people who receive the new money first, before prices have adjusted, benefit the most. The people who receive it last or never are hurt the most. In the modern context, here's how the Cantillon effect plays out. The Fed creates money and gives it to banks. Banks are first in line. They invested in assets before prices rise. Asset prices rise. Banks and their wealthy clients are richer. Eventually, some of that money trickles into the broader economy through wages, spending, and business activity. By this time, prices have already started rising. A nurse in Tennessee gets a 3% raise, but her rent went up 18% and her groceries went up 12%. She is last in line. She pays the inflation tax on money she never received. Here's a concrete example. Let's say you're a homeowner in San Francisco. In 2015, your house is worth $800,000. By 2022, it's worth $1.6 million. You've earned $800,000, not by working, not by creating anything, but simply by owning an asset during a period of asset inflation. Now let's say your neighbor is a renter. During those same years, his rent went from $2,500 per month to $4,200 per month. He has not gained a single dollar from asset inflation. He has only absorbed the cost of it. This is the hidden redistribution engine inside monetary policy. It doesn't appear in any vote. It doesn't show up on any ballot. It happens quietly, mechanically, year after year. and it accelerates the gap between those who own capital and those who work for wages. Now let's zoom out and look at the corporate side of the story. Because it's not just wealthy individuals who benefited from $9 trillion in money creation. When interest rates are near zero, which they were from 2008 to 2022, with brief exceptions, companies can borrow money for almost nothing. And what did some of America's largest companies do with that cheap money? They borrowed billions of dollars and used it to buy back their own stock. Between 2010 and 2020, S&P 500 companies spent over $5 trillion on stock buybacks. That's $5 trillion used not to hire workers, not to build factories, not to fund research, but to artificially inflate their own share price. Here's how it works. When a company buys back its own shares, the total number of shares in circulation goes down. Earnings per share, even if total earnings stay the same, go up. And stock prices typically follow earnings per share upward. So company executives, who are paid largely in stock options, get enormously richer. Existing shareholders get richer. And the company has taken on debt that future shareholders, future employees, and in some cases future taxpayers will have to deal with. Apple alone spent over $550 billion on buybacks in roughly a decade. That's more money than the entire GDP of Sweden, spent to push up a stock price. The system created a set of incentives where this was the most rational thing to do with cheap borrowed money. When the cost of capital is near zero, financial engineering beats real engineering every time. So what happened when the bill came due? In 2022, the Fed made a dramatic reversal. After years of near zero rates and money creation, inflation hit 9.1%, the highest in 40 years. The Fed raised interest rates from essentially zero to over 5% in less than 18 months. The fastest rate hiking cycle in modern history. And the consequences were swift and painful, but again, not equally distributed. The stock market dropped about 20% in 2022. That hurt wealthy investors on paper, but most of them had made so much during the previous decade that even a 20% correction still left them far ahead. But for ordinary Americans, the higher interest rates meant mortgage rates jumped from around 3% in 2021 to over 7% by late 2022. The monthly payment on a median-priced American home, which had already risen to over $400,000, nearly doubled. A family that could have afforded a home in 2020 and when rates were 3% could no longer afford the same home in 2023. Not because they became poorer, not because their income dropped, but because the cost of borrowing doubled. And those already on the housing ladder, those who bought before the rate rises and were locked into low-rate mortgages they couldn't afford to give up, which reduced supply further, which kept prices high, a trap for everyone below the asset line. Okay, so now you understand the system, and I want to make sure this doesn't leave you feeling hopeless, because the goal of understanding this isn't to be angry, it's to make better decisions. In an era of monetary expansion, the worst place to keep your wealth is in cash, because cash, by design, loses value when more money is created. The people who understood this and positioned themselves to benefit are the ones who came out ahead. They bought assets, stocks, index funds, real estate, even gold. Not because they're smarter, not because they worked harder, but because they understood the rules of the game. And here's what's powerful about that. The rules aren't secret. They're just not taught. Not in schools, not in most families, but they're accessible to anyone willing to learn them. The point is, if you don't understand how money is created, how it flows, and who benefits, you will be on the receiving end of these decisions without ever knowing it. Your grocery bill will go up and you'll blame the government. Your rent will rise and you'll blame your landlord. Your wages will stagnate in real terms and you'll blame your boss. And you'll be partly right about all of those things. But the deeper cause, the root level mechanism, will remain invisible to you. We started with a question that most people never think to ask. Where did $9 trillion go? And we found the answer, not in a conspiracy theory, not in partisan politics, but in the mechanics of how modern money works. Your grocery bill is the last stop on a journey that started with a decision made by 12 people in a room at the Federal Reserve. That's not a reason for despair. It's a reason to get educated. I want to leave you with one last thought. There's a famous quote often attributed to Henry Ford, though historians debate whether he actually said it. It goes, "It is well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before morning. Because the people who understand money don't need a reason. They build wealth inside the system. They make decisions that compound over decades. They stop being surprised by grocery prices and start being prepared for them. But here's the uncomfortable question. Is the system really complicated, or are most people simply not paying attention? And if people truly understood how money works, would anything actually change? I'm curious what you think. Write it in the comments.